Welcome to Fixed Income Insights with PIMCO, and today we're going to cover a phrase that many people have been waiting to hear. Rate cuts may be upon us. But we've heard this story before. Why is it that today markets are so confident that the Federal Reserve is likely to lower its interest rates? Well, there's two answers. The first, and probably most important, is inflation is finally back near or at the Fed's target. As you can see, it's been a long ride, but by most measures, inflation is pretty close to that 2% target that the Fed has. This means they can now, instead of being laser focused on just inflation, really consider both sides of their dual mandate. The other side being full employment. And if you look at the macroeconomic data, whether that's growth or the unemployment rate, we're starting to see signs that the economy's slowing, right? And the labor market's softening. The result has been a decent amount of volatility, whether that's across risk assets like equities or lower rated corporate bonds, or seeing interest rates across longer dated bonds rally or go down. This has been a really positive thing if you already own bonds, but we also think it's a really good opportunity to revisit the amount of cash and fixed income within your allocations. And I think a nice place to start is just by reviewing bond math. This table to me does the best job of articulating why duration is a benefit within portfolios. So as you can see across that middle row, that's the return across these different sectors if rates don't move. But as rates go lower and you move up these columns, you can see, especially in areas of high quality fixed income, your returns also go up. Where's one area where you don't see that dynamic play out? It's cash, right? 3-month T-bills all the way on the left side. They don't enjoy that same dynamic. And in fact, just one step out into ultra short or 2 steps out into the short-term category means you often do see the benefit of duration. What isn't this taking into consideration? Well, rates don't often move in lockstep across the entire curve. We like to say not all rates are created equal. If you, for example, look at the yield curve today, it's inverted. That means that short-term rates, like the federal funds target rate, are higher than rates further out on the curve, longer maturities like the 2-year, the 5-year, or all the way out to the 10 or 30. If the Fed normalizes policy rates by reducing their overall Fed target rate, what might we expect to happen? Well, you can see this other line is plotting if we returned to a more normal shaped yield curve, consistent with what we've seen over the last 30 years. As you can see, we would expect that rates at the front end drop quite a bit, as well as in the intermediate space, meaning a big tailwind, as you can see on the right side, to the 2-year, the 5-year, or other intermediate parts of the yield curve. What's one area that may not be poised to deliver? If you look further out, the 30-year Treasury, it's actually not that far off from its long-run 30-year average. We've seen many clients implement passive long-dated strategies as an efficient way to get duration in their portfolios. But what that might overlook is that not only does the long end not necessarily have to go down as much in the face of rate cuts, it's also much more volatile, especially when you start considering things like US debt sustainability, quantitative tightening. There's lots of reasons why the long end of the curve can be a really volatile place. The bottom line across all this is these things move really quickly, and active management is key. You can see something like the multi-sector category. It's poised to do well in the scenario I just described, but as these yields are changing, actively managing the duration and credit risk in portfolios, we believe is paramount. So in closing, yes, we believe that we're getting close to some rate cuts potentially from the Fed due to slowing inflation, slowing economic data across overall GDP and the labor market, and that active management and high quality duration are a really attractive way to increase portfolio returns. If you want to explore this topic in greater detail, our advisor playbook has a lot more resources for you. Or feel free, of course, to reach out to me, our team, or your local PIMCO account manager. Thank you.